thanks to the Fed's rescue activities. The excess reserve graph is especially frightening. It is our belief that the Fed should stop paying interest on these reserves. However, that is not what created the bulge in the excess reserves. It is due to open market policies and quantitative easing. This enormous stock of reserves and the rapid pace of money creation cannot go on. In a moment, Ashley will discuss with you how we intend to counter these issues. But first, Shane Brown.
And looking forward, there are three main problems that are looming over the economy. Those being the European sovereign debt crisis, the U.S. federal budget debate, and the widespread pessimism and impatience in the overall economy. These three problems ultimately create three possible scenarios that the economy will go into. The first possibility that we believe is a second dip, but slow, or short and shallow recession. The second possibility is back to where we left off, which is what currently is irrationality and a balance in the markets. The third possibility is slow but balanced growth. But we don't really think that the first one's going to happen, because we've seen the GDP grow in the past couple of quarters, and we believe that this trend is going to continue. But the second possibility is very real, due to the problems that created the Great Recession in 2008 to begin with not being fixed. Those being the exposure to international shocks, accelerating inflation, speculation in the asset markets, zero savings rate, and debt problems in the private sector, the government budget imbalances, and the malaise on Main Street. But in terms of the European sovereign debt crisis, although Germany and France have shown their commitment to the euro, there's not really a concrete, permanent solution to the problem. So it's spread outside of, or it's starting to spread outside of Greece, and in countries such as Italy and France. But this only links up to four problems to the U.S. market, and that is the equity markets in the U.S., namely the stock market, because it will remain volatile. U.S. trade from Europe will decrease. The direct lending by European banks and other businesses will decrease, and the direct links between international banks will ultimately decrease. But in terms of the second problem, which is the federal budget deficit, which is nearly 10% of GDP last time we checked, the most nagging of all three is the anxiety and patience in the market, namely the consumer and business confidence. As you can see by the Conference Board of the University of Michigan confidence indices, in 2011, the confidence in the markets decreased significantly. But, as Ashley is going to show you, we believe that the Fed does have some say over the markets. And here you go, Ashley.
Okay, so we can't do much about the three structural issues that Shane talked about. We also can't do much to ensure that the third possibility of slow but balanced growth will occur. But we can use the one major policy tool in our control to lead us in the right direction. Therefore, our team recommends raising the federal funds rate by 25 basis points now and continuing to raise it progressively in the future. There are 5 reasons why we believe this is the right action. 1, to prevent the rise of asset prices. 2, to slow down inflation. 3, keep long-term interest rates low. 4, instill renewed confidence in the dollar. And 5, raise optimism. Now I'll go into these reasons a little bit more. Most people agree that after the 2001 recession, we waited too long to raise the federal funds rate. Low interest rates and excessive lending led to bubbles in the asset and housing markets. Based on our calculations, the 2009 recession is experiencing a similar quarterly GDP growth as the previous 2 recessions. We can't wait too much longer, or we may cause another bubble in the markets. It may be commodities. The price of gold is already close to $2,000 an ounce. We also want to do it now because we can raise it progressively rather than raising it all at the same time in the future. In the words of Milton Friedman, inflation is always and everywhere a monetary phenomenon. Therefore, we need to do something about the money supply. By increasing short-term rates, we could potentially decrease long-term rates, or at least keep them low. Also, by increasing short-term rates, we could increase bank lending. Right now, rates are so low, they don't really see a point in loaning their money. And the safer option is to keep the money in the reserves so that they can make that 0.25% interest. The extremely low interest rates has kept the U.S. dollar, has depreciated the U.S. dollar. It's starting to look like a beggar thy neighbor policy to Europeans and others. By increasing interest rates, we can appreciate the U.S. dollar and instill confidence in the foreign exchange market as well as helping Europe. Fifth reason, restoring optimism. By raising the rate itself isn't going to restore optimism. The statement that accompanies the raising of the rate could do just that. We need to have a clear, optimistic, and simple policy statement saying that we have avoided a catastrophic financial crisis, and we are now experiencing slow but positive growth. The Fed is back to business as usual by working to prevent inflation, maintain a strong dollar, and avoid the excesses of the past. In conclusion, as Scott mentioned earlier, we recommend removing the interest rate paid on reserves. This will show that the Federal Reserve is not entirely a Wall Street institution, but they are also interested in Main Street. That is the end.
Okay.